Hello and welcome to another episode of NSE FinWiz, powered by CNBC TV-18 Season 3. Today we are at the Pune plant of one of India's leading luxury car manufacturers, Mercedes-Benz India. Established in 1994, Mercedes-Benz India has pioneered the luxury car market in India. Set up in 2009, Mercedes-Benz India's world-class production facility has the largest installed production capacity for any luxury car maker in India. NSE FinWiz visited the office of Mercedes-Benz India in Pune with the country's finest experts to advise and educate the young employees on investments and financial planning. And I'm now joined by our two very special experts. We have Feroz Aziz, who's the Deputy CEO with Anand Rathi Private Wealth Management. Welcome to the show, Feroz. And Harshvardhan Roongta, who's a certified financial planner with Roongta Securities. Welcome to the show, Harsh. And our core topic for today is tax planning. Harsh, tax planning, two words. When you talk about it, it's just like, it's supercalifragilisticexpialidocious. Nobody knows what that means, okay? How do you guide layman investors here about the importance of tax planning and how to, let's start correctly on this?
Well, Sumit, this particular quarter, which is the Jan, Feb and March, this is the period when you actually look forward to, closing your books and, the financial year is coming to an end. What happens is, usually when it comes to this last moment, that is the time we start thinking of what we haven't done to avail of all the tax benefits which are available under different sections. So we rush and we buy into something that is easily available to us. So convenience becomes the priority and not what actually should be done. Now, when you talk about investing money and saving tax, there are two elements. One is you have certain goals in your life, you have certain money left which you would like to direct towards achieving certain goals in your life. Now, that is the prime objective of making investments.
Right.
Now, if you have this plan in place, you choose certain instruments. You choose a product, say possibly a product A or product B or a product C. Where you will invest will depend upon where do you want to get to. Secondly, if you also need tax benefits, then you will choose a product which helps you do both. It also helps you achieve your goals and at the same time it gives you tax benefits. So tax planning or investing for tax purposes, tax saving purposes should be an ancillary benefit. Should not be the prime objective of investing.
Okay. So, Feroz, when he's talking about the prime objective, Harsh is referring to goal setting. But we will come to that on a second step. Because since our core topic is tax planning at the moment, let's talk about some of the avenues through which people can save tax. Now, we know about the ATC and people, like you said, will go in for life insurance because pata hai usse tax bach jayega. But what's your advice on some of the, maybe, the fewer ones that are not so easily known of how people can save tax?
Great. Of course, it's quite a mystery. The section ATC itself has about 15-16 clauses. For somebody to actually take benefit from each of these subsections is going to be a course in itself. But having said which, there are some which are unknown, like Sumit was referring, which a person ends up not using. And every financial year when there is a budget, for example, there will be fresher things which get added and the previous ones get modified. Now, if one which comes to me top of mind from perspective of the latest budget, actually the latest budget gave a specific clause of saying you can use national pension scheme over and above your ATC limit. So it's like a good 10-15,000 rupee gift where you can actually invest about 50,000 rupees in national pension scheme and you get a deduction. So this is supposed to be very underutilized. If you looked at numbers so far for this financial years when it was applicable, the numbers actually are abysmally small. What am I referring to? I'm referring to the additional above ATC benefit, which is the 50,000 earmarked for national pension scheme. That's on the income tax head. Okay. See, tax, to simplify it, is divided into several heads. Income tax is one, and capital gains more prominent. From a self-employed, from a professional, you have these two heads. One is capital gain, one is income tax.
Harsh, there's a question from Paresh Gaikwad, and he says, what should be the proportion for investment in LICs, mutual fund, FDs, etc., so that we can have tax saving as well as we can expect good returns?
Yeah, well, it's actually a very interesting question. Now, I'd like to just, migrate this a little bit. Instead of telling you which product you should be investing into, whether it could be LIC, could be mutual funds, could be whatever, let me bring to you the concept of an asset class. So let's, when you begin, you have certain amount of money in your hand. See, at the end of the month, you decide I wish to invest about, say, 15,000 rupees a month. Now, what you should be deciding is how much part of this 15,000 should go into equities, which is an asset class by itself. How much should go into debt? How much should go into precious metals? Could be gold, could be, any other silver, platinum. How much should go into real estate? So you could have different asset classes. Now, once you decide that, this exercise is basically called asset allocation. So that is dependent on a couple of inputs that are specific to each individual. So what is your circumstances, what are your specific goals that you have in life, what do you want to achieve, and when do you want to achieve them. So based on that, there would be an asset allocation done. Now once you do that asset allocation, and it suppose says that 50% of the money should go into equities, say probably 30% should go into debt, and the balance could go into precious metals. If this is the allocation, then the 15,000 will be divided and said 7,500 needs to go into equity because you have 50% in equities. Now, how much of this 7,500 can you invest into direct equities yourself, or would you want to invest through mutual funds? So now we've identified an asset class, and then we've gone into the products and the options which are available within that asset class. Then you look at gold, for instance. In this particular example, we've identified 20% should go into gold. So you have 3,000 rupees going every month. Then the question arises, should you invest into an ETF? Should you invest into gold directly in the form of coins? Should you go into a gold fund? Or should you go in for that gold savings bonds? So that would come after you've got the headline clear. So this is how you would technically go about. All these products, when we look at asset allocation, will give you options for tax savings. Now if in case 50% equity, so you have an option to go in for an ELSS scheme or a regular scheme. If you go in for debt, so we've said 30% goes into debt. So debt could be in the form of a PPF, which gives you tax benefits. It could be in the form of an insurance policy, a non-ULIP or regular traditional policy. It could be even into national saving certificates. It could be tax saving fixed deposits. So the products come in much later after you've ascertained how much goes into one particular asset class. This is the correct method of going about it. And then you will automatically get money to allocate into different products within those categories.
On that note, it's time for a very short break. Don't go anywhere. We'll be right back. Welcome back. You're watching NSE FinWiz powered by CNBC TV-18 Season 3. I have two very special guests with me, Feroz Aziz and Harsh Roongta. Harsh, when we start talking about personal finance, the first thing that any advisor says is to set your goals. That is, that's your roadmap to a brighter future, a better future. How do you advise someone to set goals? Because the concern is when you take a pen and you take a paper and you start writing, it gets so overwhelming. I don't know how much money I want in 20 years. I don't know what it's simple as that. You start mumbling and bumbling. You don't know what to say. How do you advise? How do you ease this process?
Oh, well, there are two steps to this. The first step is to make a wish list. Now that wish list need not be practical. It need not be doable.
SLSAMG.
You just need to pour down your thoughts and your wishes. It could be as abstract as I want to buy a Mercedes-Benz in the next 1 month, in spite of the fact that you know that you do not have that kind of funds available with you right now. There's no harm in having a wish list. So what do is just note down those wish lists. There's something that I want to achieve in the next 1 year. I want to do something over a period of 3 years, or this is what I want to do for the long term. You could have children who are very young, so possibly you may have some thoughts for them as well. You might not know what exactly they're going to pursue because their interests are going to be different, but anything that they pursue, there's going to be some amount of cost associated to it. There could be some goals that you have, but you do not know the cost. Like you may say that I wish to save for retirement. But you do not know how much do you require at the time of retirement. So the first step would be, I need to save for retirement. That would be identifying your goals. So the first exercise that I mentioned is called identifying your goals. The second exercise you would do in a practical note is to start quantifying your goals. There is no point in saying I want to save for retirement and you started doing something and you landed up saving just 20 lakhs. Whereas you needed 2 crores. So does that the purpose of planning serve its purpose? No, it does not. So identifying your goal, which is retirement, quantifying your goal is actually identifying how much amount you require at that point in time, and then based on these two figures, you sit down with what actually you have in your hand today, whatever your scenario is today, some investments you must have made, there could be a financial situation that we have. So based on those, we draw a line, a roadmap from point A to point B. This is where you are today. This is where you need to get tomorrow. This is how you should be traveling.
I have taken say home loan of 10 lakh rupees and I have 10 lakh rupees in my mutual fund account. So whether to sell 10 lakh of mutual fund and then to repay the loan, and then after that whatever money I will save through EMI, what I have to pay earlier, then is it a better option, or to continue with the home loan is the better option?
Home loan is the least priced loan known to an individual. Because of its security, the bank lends to you at least prices. In a falling interest rate scenario, which is what we are going to see over the next few years, you should ideally keep the loan alive. Okay, because you have got long-term funding at reasonable costs. Since yours is a home loan, I suggest in a falling interest rate scenario, you should hold it up. But very importantly, if you have taken a loan and also had an investment, if the investment is in very conservative, short-term instruments like debt funds, then it will be counterintuitive, because what you earn is going to be lesser than what you pay. So you're better off closing it. So investments in the true sense would mean long-term assets or substantial exposure on equity. If that's the case, then both can live together in a falling interest rate scenario. So you have to introspect and see what portion of my 10 lakh rupees is there in equity, and if that's a large portion and not debt funds, then you should certainly keep it alive, because home loans will also bring in peripheral tax benefits which will increase the efficiency and increase the differential. Now coming back to a very important thing, how much would I make? Long-term historical averages of investing in equity mutual funds is like about 16 to 17%. 10, 15, 20 years. So home loan is a 10-year, 15-year loan generally. So 10, 15 years, if I just blindly invested in an equity mutual fund, I would still be left with a differential return of 6-7%, and it's as good as my money is twice hard. So 10 lakh is the interest I pay, but my money is working like 20 lakhs. So you should keep them alive.
Most of the ULIPs have performed miserably, and investors have burned their fingers. Don't you think it is prudent to treat these two things like investment and insurance as two different baskets with two different motives, and not to mix them up?
When we see this scenario wherein we talk about unit-linked insurance policies, it's been long that we've been advocating that you should not be buying any investment-based policies. The reason being because you do justice to neither of the two. You do not buy a life cover in the proportion that you should be buying. At the same time, you're investing into a product which is ideally not designed to be an investment product, which is an insurance policy. So if you need to buy a life cover, the best way to buy life cover is to buy a term plan. And you have options available which are direct online policies wherein you interact with the company directly and you get a policy at a very competitive price. If you need to make investments, you could choose mutual funds. Now what are ULIPs? In a ULIP also you get NAVs, they function like a mutual fund itself. So why would you combine it? I mean, I am completely in sync with what you have mentioned. You could go in for a mutual fund and be more flexible in terms of liquidity. Now if you talk about just one aspect, which is liquidity, in a ULIP the insurance law regulations say that you need to be invested for at least 5 years. So while you have a choice to stop your policy within 5 years, the money does not come to you until 5 years have been completed. Whereas in mutual funds, you may just simply withdraw the time in open-ended mutual funds schemes. You could simply withdraw and redeem whenever you don't wish to continue any further. So I don't see a value addition in real sense that you should go into a product which has got insurance and investments together vis-a-vis something which has two separate things. Then why does a product still be available in the market and why does it still sell? Well, there is some, every product has been designed keeping in mind some requirements. There are some investors across the country who would want to have both together. They do not want to manage two separate products. So every product has a buyer. So in that context, there is somebody who's buying it. But in case you are one of them who can manage an insurance policy on its own and keep it alive, and also at the same time manage your investments and track it. So I don't think there's any reason you should buy a ULIP together.
You're watching NSE FinWiz, powered by CNBC TV-18 Season 3. Time for a short break. We'll be right back. Welcome back. You're watching NSE FinWiz powered by CNBC TV-18 Season 3.
I am a regular investor in mutual fund. So when I invest in tax saving mutual fund, ELSS, so which option should I use? Growth or dividend? And in dividend payout or reinvestment?
If you're buying an open-ended fund, okay, to answer that question I'll have to describe. An open-ended fund is a one which you get in and get out on your whims and fancies, right? Of course there could be some cost if you redeemed it before a year, but going in and out are called open-ended. ELSS schemes marginally are closed-ended because you can't remove your money for 3 years, right? Generally what people should ideally choose when it comes to an ELSS scheme is take a payout so that you get the discretion to reinvest or not to reinvest. Otherwise, let's assume at the end of 2.5 years and you have 6 more months to finish your 3 years, if there is a dividend and you've reinvested it, then that new dividend is going to be locked in for 3 years from then, right? So dividend reinvestment is out of the window. Either you choose growth or dividend payout. If you choose growth, you will never have this problem of some units being stuck for longer than 3 years. But if you, so basically growth or dividend payout. If there are larger quantums, choose dividend payout. If it is smaller quantums, choose growth, because a small dividend coming in, due to lethargy and logistical difficulty, you will not be able to put it back and you will miss the 8th wonder of the world, which Albert Einstein and Warren Buffett both subscribe to, saying the 8th wonder of the world is compounding. If you don't take the money and let it compound, that is when it becomes big.
You know, there's this thumb rule that they say 100 minus your age should be invested in equity, which basically helps you in your asset allocation. So is that a good thumb rule to go by, or are you, do you not believe in that thumb rule? Or what's your advice?
Well, Sumit, let's understand this with an example. There are 2 individuals working in the same department of this company. Both are 30 years of age. So as per the thumb rule, 70% of investment should have gone into equities for both these individuals.
True.
Now this is the thumb rule. So in the absence of any application of mine, this is what both Mr. A and Mr. B should have done. Now when we dig a little deeper, now Mr. A had a situation wherein he had some moral responsibilities on him. He had to get his sister married after 1 year. Okay, and Mr. B had no such responsibility, and he could save for the next 30 years without any obligation to pay in the next 30 years. Would this rule then apply to both of them? No. So this rule would not apply, because Mr. A had to save money in instruments which he requires after 1 year. So he cannot most certainly invest into equities. In fact, it could have been 80% into debt and 20% for long-term goals. However, Mr. B, we had no other responsibility, and his money was to be staying in the product for next 30 years. Then he could invest 70% into equities. So in the absence of making any other detailed investigation into the person's individual requirements and lifestyle, if you have to still do something, then the thumb rule applies. Right. But it is still, definitely I would say, it is not the only way that you should go about deciding what is your asset allocation. It could be fatally wrong. It could get you on the wrong side and really cost you a lot of money in that context.
Looking at the property rates right now, is it good enough to sell one property and buy another property? Is that a saving?
Firstly, if you are selling something or buying something from a consumption perspective, that's a very personal choice kind of a opinion. But if it's basically a financial transaction, that's where mathematics comes and emotion takes a backseat. If you are selling the asset because you're bearish on real estate, then buying back real estate will not make mathematical sense. 2 methods to understand the value of what you buy. One is, how many years salary am I spending to buy the house? Earlier it used to be 2-3 years of salary during the previous generation. Today it is 20, 10, 15, 20, 30. Depending on what property you buy. That's called the affordability quotient. The second is, how much do I pay the landlord to acquire the property for 50 years? How much rent will I have to pay today? If the ratio is, or to buy the house I'm paying 1 crore, to rent it for the next 15 years, if I pay him 15-20 lakhs, I'm able to rent it out for 50 years, what would you choose? 50 years is as good as owning the house, right? So that's called a virtual lease. You're virtually assuming that if I actually took a lease. So that is the two technical nomenclature which people go through in real estate to see whether you should be a buyer or a seller. Coming back to your question, don't sell a property and buy one more if you're actually exiting because real estate might not have a very bright future.
On that note, thank you so much, Feroz. Thank you so much, Harsh, for coming here. Thank you so much for having us here.
Many doubts I had regarding this taxation and funds and everything, it got cleared. It was very impressive for the youth generation who doesn't know about all these things right now. Maybe it was very helpful for them as well.
I learned a lot about some new things like the NPS scheme, which I really wasn't aware of. And in addition to that, the asset allocation part of it, how much into equity, how much into debt. This was an eye-opener. I really enjoyed the show.
Well, that's all on this episode of NSE FinWiz, powered by CNBC TV-18 Season 3. But before we go, here's a chance for you to win a cool goodie bag by answering this viewer question. A close-ended mutual fund has a fixed A. NAV, B. Rate of return, C. Fund size. Send in your answers at fwq@network18online.com. The correct answer to last week's viewer question is option C. There is more systematic risk involved for the common stock. Many thanks to all the viewers who sent in their replies. The winner to episode 14's viewer question is Udaya Aditya. We'll see you next week with another set of young employees at another company. Until then, from the entire team, many thanks for watching.